I've got to read a script.
Come over here, Sue. Yeah.
So this is the Oakville chapter of the Canadian Society of Technical Analysts. It is Wednesday, December 12th, and tonight we have the distinct pleasure of having one of our own members, Dave DiMarcantino, make a presentation to our group. Sorry, I love that.
That's okay.
Many of you know Dave already. He's been a member for about 8 years, and he's also a past chapter head. He's very proficient at programming, and I can tell you that I've seen a couple of Dave's presentations in the past, and I always come away with something really, really great. So I think we're in for a real treat now that we're getting things underway. Tonight, Dave will be discussing the results of backtesting several well-known indicators and the often interesting and surprising results you get when you apply strict methods and analysis. The PDF to tonight's presentation will be available to attendees in the next couple of days. To Evernote people, it will be available tonight. The title of Dave's presentation is Technical Analysis and Historical Comparison of Technical Indicators and Performance, Demystifying what works and what doesn't. And without any further ado, Dave.
Thank you, Sue. So are there any questions? We're done. So I just wanted to thank the CSTA. Thank you, Sue. And thank you, Blair. Blair couldn't be here today for allowing me to present some work that I've been working on. This was a presentation I developed, and I just actually recently updated it with a lot of new good information. The working title is Historical Comparison of Technical Indicator Performance. We're going to demystify what works and what doesn't tonight. Sue, if I can just ask you just to hit that little, the arrow button. Yeah, perfect. And then we can check in every once in a while if there's any questions. So I'll just give you the next slide like this.
Yeah.
Thanks. So, sorry, you just need to press the up and down. That should do it. So you just need to open that. There.
Oh, there we go.
Oops. You jumped one. Oh, okay. So I actually updated the presentation with one slide. So the one slide that I updated was just a quick overview of my journey, and I think it's good to have some perspective. So I went from a journey from being a discretionary trader to what I would consider a systematic trader. And that journey sort of looked like me starting out in 2006, 2007, and making a lot of mistakes. I started out first as a value investor. So does everybody remember Value Line? Anybody ever use Value Line? That really expensive subscription with tons of metrics that could just like makes you look or feel very smart, but it just blows your mind with all kinds of data. So it's kind of funny. I've come full circle to data. It's just different data. So, I started out with that, and then my journey sort of led me on using and discovering technical analysis as a decision-making tool. And then from that point, I probably made every mistake in the book, as I'm sure a lot of you probably have as well. I cut my teeth during the financial crisis. I made there might be one or two mistakes I didn't make. So that led me on a journey to learning. And in 2011, I opened a small trading room in Burlington, and it was designed, there's some members here. Doug was a member of my trading room. And really what we were trying to do is we're trying to network and find other traders and investors that sort of crack the code to understanding the financial markets and to trading. So I'm a do-it-yourself investor through and through. I've never worked for a firm. I've never worked in the industry. This is all sort of, trial and error and learn while you burn. So from 2011 to about 2014, I ran the trading floor as an experiment to see if we could, find successful traders and understand the markets better, and just put in that 10,000 hours. Put in the reps, put in the time to understand charting, understand technical analysis, and see if we could figure this thing out. So that sort of led me on the journey. I joined the CSTA around that time. I was the chapter head of the Oakville chapter for about 3 years, between 2011 and 2015-ish, I guess, 2012, 2015. I was on the board of directors for the CSTA for 2 years. Long story short, I went on this long journey. It took about 10 years to finally crack the code and figure this out. And it's surprisingly a lot simpler than you would think. And we'll get into a little bit of that. But the journey that I went on essentially took me from being a discretionary trader to being more of a quantified systematic trader. And so I'm going to take you on some of that journey with me. So that just to sort of set up the perspective. Okay, so I don't know about you all, but I've often wondered, and I look like that, just like that guy, I didn't have a face, exactly which technical indicators actually work and how well do they perform. Can I just get a show of hands? How many people have often wondered, which technical analysis indicators, what works? And okay, so there is some interest in this presentation. Thank you, Steve. Okay, please, Sue. So just a quick disclaimer. Next slide, please. So I'm not going to read the entire disclaimer in terms of use, but basically this is a trust and verify. All information is presented at your own risk. So just assume I don't know anything. Okay. Okay, so I always like to start out my presentations with the objective of the meeting. So what we're going to do is we're going to review and compare the historical results of most of the common technical indicators, and we're going to demystify what works and what doesn't. So the rules for testing are kept really simple. So just a preamble here, another preamble. I want to keep this fairly high level. There's going to be a lot of graphs. There's going to be a lot of numbers. Don't get scared by all the data. I want to try to simplify this. I keep my presentations packed with information so that you can actually go and read it afterwards. So I want to keep this very high level, okay? So the rules for testing are kept simple. We're going to just buy on overbought mostly with oscillators. We're going to sell on oversold. We're going to buy on positive crosses, sell on negative crosses in the case of moving averages, MACDs, and the like. So what we essentially want to do is we want to compare and contrast which indicators actually work and comparatively speaking, how well they performed over the last 18 years. So our test date is from January the 1st, 2000. So just a quick warning, no technical indicators were harmed in the making of this presentation. I just want to be clear. Thanks, Sue. So the testing procedure, let's set this up. So my symbol universe is the S&P 1500, and you're probably wondering why. The next slide will tell us. So the S&P Composite 1500, it combines the leading indices, the S&P 500, S&P Midcap 400, the S&P Small Cap 600, and it covers approximately 90% of the U.S. market capitalization. So when I do my live trading and when I do my testing, I typically stick to the S&P 1500. And the reason why is because you get a broad range of different things to trade in different markets. So it's designed for investors seeking to replicate the performance of the U.S. equity market or benchmark against a representative universe of tradable stocks. So I use the S&P 1500 universe a lot in my testing and trading. As I said, it allows diverse exposure to small, mid, and large caps. So we're going to look at two testing methods, and the two testing methods are portfolio trading and what's called an all trades test. Now, we're going to rely on our results for portfolio trading because with an all trades test, a portfolio test is like saying, okay, I'm going to take, actually, let's go to the next slide and we'll. So it's like saying, look, I'm gonna set my account size, right? Because your compounded annual return and other metrics are going to be tied to the parameters that you set up in your trade. So I've done a number of back tests that show about anywhere from 10 to 20 positions when you're running a portfolio is typically the optimum. So essentially what we're going to do is we're going to say, okay, we've got $100,000 account size. We're going to run 20 maximum open positions. So it's just very simple position sizing. And we're going to remove a ranking bias as much as possible. For the AMI broker guys in the room like Omar and JB, IJB, we're going to use a formula where we set the position score to the close minus the floor close. So all that's doing is it's basically allowing us to get a random result ranking when we get signals in our universe without giving precedence to anything that has to do with ranking by relative strength, just to simplify it. So again, our symbol universe, S&P 1500, time frame is always going to be the daily time frame. So with the data, what we essentially want to do is we want to remove pre-inclusion or survivorship bias using historical constituents of the S&P 1500. Does anybody not know what that means? Okay, so essentially when you get data, there's a lot of data sources out there. I use a data source that's what I consider probably the best data source for this kind of backtesting. And what it does is it says, like, for example, the way I used to test is I'd say, okay, here's the S&P 1500, and I'm going to test against that universe of stocks. The problem with that is the stocks that are in the S&P 1500 today may not have been in the S&P 1500 on January the 1st, 2000. They might not have been there on January the 1st, 2001. So that's what's called survivorship bias. Those stocks that are in the universe today made it. You know, they're the winners. They're here. They're staying. So what I do is I use a data source that actually it tracks the historical constituents of the database of the S&P 1500 so that it only looks at stocks that maybe were delisted. That they're delisted now, but they were a constituent of the S&P 1500 at that point in time. Does that make sense?
So that means the whole period from January 1, 2000 to today, they're still in there.
They may not be. They may be delisted. So what happens is if there's a stock, let's say, that didn't make it to today, but let's say it was in the index on January the 1st, 2005, and it would have taken a trade there, it will actually know that because the data is there, and then it will know when it was delisted. So if, let's say, you're in a trade and it was delisted, it will actually get out of that trade. But the problem with not using data like that is it just assumes that you're only trading the best stocks that survive today. So in my universe of S&P 1500, there's about 1,500 stocks, as you would expect. In my historical database, there's almost 4,000. So I think 3,600. So 1,600, or I can't even do math when I'm on stage. More than half of those are just, they don't exist any longer. Okay, they're delisted. They no longer exist. But the data exists for the purposes of testing. So what it essentially does is it gives you a more realistic view of what would have happened in the past. Does that make sense to everybody? I think that's important to understand before we move forward. Okay, I know Omar gets this. Yes, Phil.
What's close minus floor?
That's just that's an actual formula that I use in AmiBroker. So most of this testing has been done in AmiBroker. And for those that don't know, I mean, there are Steve, Omar, JB. I know you're all members of the AmiBroker group that we recently started. If you're interested in learning more about AmiBroker and being more systematic, that's a great place to start. You can join us at the AmiBroker meetings. We hold them the first Tuesday of every month. So that's just a formula we would plug in to AmiBroker.
What's the difference between close and floor close?
It's not really relevant for this.
Okay.
For this, we can talk about it offline after if you want. Okay, sorry. Go ahead, Sue. Okay, so
This is the same slide.
this is the same slide.
So what did you do before to get it?
Just down,
Stuck.
the down arrow.
Yeah, it's freezing.
If you go off screen,
Okay.
then you just need to click on here to give it control, like to
Okay.
give it
Yeah.
focus. Okay, so as I mentioned, the entry and exit rules. Simple rules: overbought, oversold, crosses. Exits take place on the closing price of the current signal bar. This might actually be difficult to duplicate in real time versus next bar on open after the signal bar. So entry signal is either from the close or the close of one bar ago. A good example of that is you see a lot of people when they're testing moving average crossovers, and they say, well, I would have bought on that bar. And you say, okay, well, when would you have bought? Well, I would have bought on the open of the cross. The problem is that it actually doesn't cross until the close of the bar. And we'll talk a little bit about that, but that's why it's important to use a computer generated program and try to avoid what's called future leak. And I'll describe that a little bit at the end of the presentation of things to be aware of. So
So just on that, exits take place on the closing price of the current signal bar. So if there is a moving MACD cross during the day and it's still there at 359, you'd put the trade in at 359.
Correct. Correct. So it will assume that you're using a super fast computer system that knows it crossed and it bought right on the close. Okay. So that's an assumption. And we look at that assumption, and we also look at a more realistic assumption, which is buy next day on open, right? Because you have a signal at the end of the day, so you buy the next day on open. So we've made some adjustments for the data. So we're not using any stops. We're not using any commissions. We did some optimization for parameters. Hopefully we didn't curve fit any data. So for example, like we're going to use standard values like the RSI 14, CCI 14, but we're going to optimize the values for the overbought and oversold thresholds, if that makes sense. So you might want to buy at this overbought level versus a lower level, or so we've optimized those. Now you can go down some pretty deep rabbit holes when you do this stuff, and you can say, well, I want to see what the best RSI is from 1 to 200 for all these 1,500 stocks. I mean, you can go down some rabbit holes. So we just tried to keep this simple because what we want to do is just establish a baseline and a benchmark for the common indicators that most people learn about when they get into technical analysis. See? Thanks. Okay, so here's some data adjustments. My data vendor allows me to do some adjustments for data. I'm using the capital, capital reconstructions and special distributions, right? So you can do adjustments for cash dividends and things like that. So essentially what it's doing is, if there were any capital reconstructions, any special distributions, it's adding it back in. I believe it's adding it back in. Okay, so those are some of the adjustments you can do. So the testing procedure number 2, which we're not really going to focus on, it's sort of an ancillary test so that you can look at it from the perspective of, okay, if I would have taken every single signal that happened in the S&P 1500 for a specific trade setup, then these are the statistics it would give me. So basically what you do is you just say, I'm going to buy 1 share of every stock whenever there's a signal. You make sure you have enough capital allocated, and it will just buy every. So what it might look like is a portfolio test might say, well, you took over 18 years, you took 20,000 trades, 5,000 trades, whatever it is. An all trades test might take 300,000 trades, right? And the reason why that's important is because it's kind of like the law of large numbers. So the more occurrences you can get, the closer you're going to get to your stated edge, right? The closer you're going to get to the accuracy of that system. So you just kind of want to see if those metrics are in line with your portfolio metrics, and they're typically fairly close. Okay, so sorry, where was I? Okay, so the all trades test, yeah, so we set the positions to 1 share. We're going to take up to 1,000 positions, and the important metrics that really come out of that are like the win-loss rate, the expectancy, which is important, but some metrics like the compounded annual return are meaningless when you get the results back from the all trades test. So the more occurrences you get equals the closer to your expected edge. That's really the point we're trying to make here. That's it. Thank you. So now we're going to talk about something that Howard Bandy calls the objective function. Matt Radke in a presentation he did to us the other night called it does anybody remember what Matt called it? The something function. Anyways, utility function. Thank you, Steve. So the objective function is basically we need a simple metric or a key performance indicator. It's required in order to compare and rank results, and it just kind of simplifies everything. So it's actually something that's subjective to the person running the test or the system developer. And the reason why it's subjective is maybe Doug, for example, is only interested in the compounded annual return, and he doesn't care if he takes wild drawdowns because he's a pretty wild guy. He plays hockey, nothing scares him. So
I take big drawdowns.
So essentially, it's going to be subjective. Some people might be more concerned about drawdown. My objective function is the compounded annual return divided by the maximum system drawdown. So the reason why I like that is because it gives me the maximum system drawdown that the system saw, which in most of the tests we run is typically in 2008, as a matter of course. But what that tells me is if the poop hits the fan, I'm going to try and keep it clean here, guys. If the poop hits the fan, what is my worst case scenario? And am I comfortable with that risk? I like that metric, and that's just something that's comfortable for me. So with the car MDD, the higher the better. So in terms of trading system development, just to put it in perspective, a car MDD of 0.5, it's a good starting point for a tradable system, especially after commissions. So what that means is, as an example, you would get a car MDD of 0.5 if you have a 10% average annual return and your maximum system drawdown was 20%. Sue.
Question from the remote people.
Okay, sure.
It's from Wayne. He says, is there any way of building the 4,000? Just do history searches on the New York Stock Exchange or NASDAQ? Is there an easy way of building the 4,000?
What is he referring to? The all trades test? Sorry, Wayne, could you rephrase the question, please? So why don't we pick that question up at the end of the next slide? Okay, so like I mentioned at the beginning, don't let all the data scare you. We're going to start getting into data, and I want to keep this really high level. Okay, go ahead, Sue. So here's all of the metrics that I typically look at. The most important ones are really, for me, the car MDD and the expectancy percent. So those are the most important that I usually focus on. Sometimes I'll start to look at, okay, how many trades did we have? Obviously, people want to know what their win rate is, right? How many percentage were profitable, how many were not. So this is just in here more for study after the fact, if you want to go through the slides. Okay, so here's the indicators we're going to look at. Let's start diving in. So we're going to look at the RSI, CCI, DMI. Can anyone else find one that rhymes? No? Okay. The Arun, the MACD, Stochastics, moving average crossovers. I always pronounce this wrong. Shaken? Shaken. Thank you. Shaken money flow. And we're going to look at the MFI. I should have put the MFI with all the other rhyming ones. But I actually added this last because JB brought it to my attention and I thought it would be interesting to add. So thank you, JB. Sue? Do we want to just check the questions quickly? Maybe Wayne rephrased his question before we get into this.
No. You built the S&P 1500 with all stocks from 2000. That means I need to know all stocks that
Wherever in the 50.
Just looking for a pointer of attacking the problem and building the history.
Okay, so Wayne, that is actually a function of my data provider. I use Norgate. I use the new NDU, and they manage all of those historical time series sort of tracking. Like they manage the database. They provide some scripts that you add to your AMI broker script, and what it does is it just tracks it automatically. So what it'll do is when you run the backtest, it'll spit out a trade list so you can see what actually traded and on which dates. I hope that answered your question. If not, we'll check back in with you later. Sorry about that. Okay, so let's start with the relative strength index. Go ahead, Sue. Okay, so I always like to use visuals. We're all technical analysts. We love charts, right? So this is essentially what an RSI would look like. You've got an buy on oversold, sell on overbought. Okay, so that's obviously I cherry picked a winning trade just to demonstrate. Okay, go ahead, Sue. Okay, so our optimized values, when I ran the optimization, so we're going to buy less than 25 on the RSI 14, and we're going to buy when it goes over 30. Okay, it seems like a pretty tight range, but that's what optimized. Sometimes you're surprised by the results of what the data shows you. Go ahead, Sue.
Sure. When it closed on those?
Yeah, we're buying on the close. So it would close on RSI below 25, and it could go even lower, right? Because we're not using any stops. So like our maximum adverse excursion could be 20%. It could be anything.
So you bought it when the RSI was below 25?
Yes.
But you sold it at 30.
Right.
Sold it at 30, so
That-
you're.
That's,
Can you go to the previous slide, Sue? One up. Okay, so let's say the RSI is at 25 here, and it closed at 25. So we would buy here, and let's say it went lower, right? Then we would be in the trade, and then when it went above 30 on the close, we would sell.
just at 30 itself?
It could close at it could
Yeah.
it could
go up,
close the
yeah.
day before at 25,
Yeah.
and the next day it could close at 55,
Yeah.
and that's a sell signal.
Okay.
So it's not going to be an exact, right? Because we're measuring the RSI on the close of the bar.
You don't wait for it to go to 70, which
No.
is overbought.
No.
74 is overbought.
No. Does that clear?
I think it's clear. I'm just surprised.
So am I. So we said that there was going to be some surprises here. Sorry, this gentleman had his hand up. Sorry.
When you have a position size up to 20 positions, do you allocate all of your funds into the trade when that trigger goes, or do you step in with over 2 or 3 tranches?
Whenever you get a signal. So if there's a slot, if there's a slot open, then you know, like if you've got 19 positions and you get a signal, then you're going to fill that next one with the 20th position. If you have 0 positions and you have 20 signals, that day you're in 20 trades.
So this range by 25 sell 35 has been optimized.
It's been optimized.
Maximize the positive winnable trades.
Yeah, it's been optimized according to my objective function. If I optimized it to a different function,
Yes.
the results might be slightly different.
Okay.
Okay, so try not to focus on what the values are, because it's actually, you're not going to go, I'm going to tell you right now, these are not tradable systems. This is a study to see what the indicators optimized values were over 18 years. And, you know, as an average, and we all know the flaw of averages, right? So you can optimize things over every couple of years. So these results might not be good in 1 year, but they were great in other years, because this is an 18-year study. So don't focus on the actual values. Sorry, Doug, go ahead.
Does that chart represent all of the stocks, like all 1,500, or is that an index? What's that chart based on?
Well, when we get to the next chart, I'll explain it. Okay. Was there another question at the back? Sorry, is that you, Gordon? Or
Yes, it is, dude.
Hi, Gordon. Sorry, I can't see that well. So
I'm wearing my glasses for you.
okay, thank you. Nice to see you. Okay, go ahead. Okay, so here's some key metrics, and here's the equity curve. So the first thing I always do is look at the equity curve, and I say, like, is it a fairly smooth equity curve? Here's the profit table, right? And here are some of the key metrics. So just a couple of things. Like I said, I want to keep this pretty high level, because what we really want to do at the end is we want to figure out which ones perform the best. So, but when you look at this, the way to read this is you want to look at the equity curve. You're like, ouch, that was a pretty big drawdown from peak to trough in 2008. So but the rest of the equity curve looks pretty nice, right? So if you look at the profit table, what this is telling you is, so this is taking, to answer your question, Doug, this is taking trades whenever you get a signal on that universe of 1,500 stocks. So one day you might be in IBM, the next day you might be in GE, the next day you might be in Apple if it's a constituent of the S&P 1,500 and you have a valid signal and you have a slot open, right? So because you've got 20 positions. So that could be a combination of any trades. There's actually, if you look at the more detailed report, there's a trade list. And it will tell you exactly what trades it took on which days. And you can spend hours going through that. I usually don't. So what this is telling you, though, is here's 2000, 2001, all the way to 2018. Here are the months, January, February, March. Here is your profit per year, right? And you can see there's some pretty big swings between, it's kind of hard to see the numbers, but there's some pretty big swings. Like this is a 1% year. This is a 49.9% year, right? So like I said, the flaw of averages, right? This was a losing year. So you can see and this is a theme you'll see throughout the presentation. Most of the drawdowns took place in 2008, as would be expected. So, so the interesting thing about this is when you look at it, you can't see it at the bottom, but it will average the months. So you can see which months were actually positive on average and which months were not. So some of the gang from the Emmy Broker Group has been talking about seasonality, right? And you can kind of look at that and say, well, maybe I should allocate my portfolio a little bit differently based on the historical performance of my trading system. So that's something to consider. That's something we're going to be looking at. Okay, so the thing I wanted to just show, so my objective function here, my car MDD is 0.18. Look at my drawdown, 62.52%. I challenge anybody to stick with a system like this. It's impossible. I mean, if you have a 62% drawdown, you're going to jump ship. So just keep that in mind. So like I said, I just want you to understand a couple of key metrics because, I don't want to information overload you. Want to keep this pretty high level. So the key things I'm looking at is expectancy percentage. So what this tells you is 0.52%. On average, between your wins and losses, you're going to make about 0.5%, right? So, so if you look at, for example, your average winners are 4%, your average losers are minus 6.5%, your win rate is 65%, your loss rate is 34%. So when you actually kind of look at the average of all your wins and losses, you're going to make about 0.5% a trade. That's what you can expect. So that's what we call positive expectancy, right?
But what does that mean? Like,
it means that you can make on average about 0.5% a trade.
It does not seem rather small.
Yes. I'm definitely not saying trade the system.
No, I'm just saying.
Yeah.
Could it almost be statistically insignificant or something? Or you've got enough? I guess you got to have enough sample size to say yes.
Well, I'll let the trading gods decide that because I mean this is not a real trading system. This is more of a study. If I was looking at a system like this and I started putting all my commissions and stuff like that in, I could tell you I wouldn't trade this. So let's just be clear on that.
So at risk of asking the obvious, that your optimized values were the 25 and 30.
Yes.
So all other combinations had worse results than what you've got on here.
Typically, according to my objective function, they did. They had lower results for the car MDD. Yeah, because that's what I optimized to.
How do you actually define your objective to which you optimized that?
How do I define it?
Yeah. What was actually the objective?
So my objective function is to take the average annual return and to divide it by the maximum drawdown. Oh. And then when I get this figure here, when I run does everybody know what an optimization is? Maybe I should kind of backtrack a little bit. An optimization is saying, I'm going to test something between all these different values, and it will test every single value or every combination of values. And then what it'll do is it'll just sort them in a spreadsheet-like format to tell you which was the highest value. So it basically does a blunt force test on all of the different ranges of things that you put in there. So for example, if I'm optimizing for RSI 14, I might say I want to buy when the RSI is 1. I want to buy when the RSI is 2. I want to buy when the RSI is 3, all the way up to, let's say, 30. So it'll run all of those tests, and then it'll sort them by the best result. Okay, that's something that as humans, we couldn't do that. Well, maybe some of the women in this room could. Okay, any other questions? Okay, let's move on. So here's my all trades test. So the only things I really want to look at, my expectancy was a little bit higher, and my maximum drawdown is a little bit lower, but this calculation doesn't always work. But what we want to see is we've got a lot more trades, and the expectancy is still pretty good. Okay. I don't want to focus too much on the numbers for the all trades. Go ahead, Sue. So now let's look at does everybody kind of have a grasp of what we're doing? Because if we do, then what I can do is I can rip through these pretty quickly, right? Because what we're going to do at the end is we're going to pull it all together. We're going to look at it in one comparison chart to simplify it. So is everybody cool with that? Because I don't want to overload you with data. Is everyone cool with that? Yes? Steve?
Just another question. You're looking at each of these indicators on their own with no compounding impacts of...
It does. That's something that's very difficult. With the all trades test, there's no compounding because you're just buying one share. But when you're doing a portfolio test, there's really not an easy way around the effects of compounding your capital.
Sorry, I didn't ask that very well. Like the example you just showed us with the RSI 25 and sell it on the 30, you didn't take that and look at it in a 50, in an environment where the 50 moving average is moving up.
No.
Or you're actually taking more
I
than
didn't
what
use
it
any
is?
macro filters. I didn't use any bull market filters. I didn't use any other logic except the simple rules.
It's just the one thing.
Yeah, buy and sell. How does the indicator perform? Because as you know, Steve, when you're starting to develop a system, yeah, you're going to start adding some macro filters in there. You're going to, you might say, did anybody listen to the presentation today from Larry Connors and Cesar Alvarez? So one of the things that they suggested, you can probably catch it on the webcast. It was a webcast from the MTA, and the CSTA rebroadcast it, which was great. Lots of reasons to be a member of the CSTA. So one of the things that they sort of simplified, or that they sort of said as just a catch-all, was, hey guys, you generally want to be long the S&P when you're above the 200 moving average, and you want to be not long the market when you're below the 200 moving average, right? And they showed some other statistics about the volatility of prices when you're above, and the volatility is over twice as much when you're below, right? So there's certain things that like when you start developing systems, there's certain things I can attest to the fact that is true, because I've tested a lot of systems. And one of the best market filters you can use is just to say, hey, I don't want to be long when I'm below a certain key moving average. And that moving average in their instance happens to be the 200 MA. So that, you can make certain generalizations like that. I call those macro filters. Okay.
Would that be simple MA? 200 simple MA?
It doesn't matter. It can be they were talking about the simple MA. I've tested it with EMAs. Same thing. Yeah. Okay. CCI 14. So here we had a buy signal, and you see we took some heat, and then eventually it hit the target, right? So with the CCI, this is what a CCI trade looks like. But it's important to note, because we're not using any stops, we can take some heat on these trades, okay? Because these are just very simple rules. Go ahead, Sue. So the CCI, these are the values it optimized at. Buy when it's minus 100, sell when it's positive 40, greater than positive 40. Okay, go ahead, Sue. So here's the results. So you can see, we had quite a bit of a drawdown 2018. Equity curve looks pretty good. 2015, 16, we had a bit of a drawdown there. But you can see it has a positive expectancy, 1.64%, a little bit better. Maximum drawdown, almost 58%. Right? I challenge anyone to stick with a system like this. Okay, CAR MDD was 0.21. Go ahead, Sue. So the all trades test, expectancy 0.65. It's still pretty close. Took 212,000 trades. So we know we're getting some pretty good statistics here. The maximum system drawdown, 32%. Now here's something that can you go to the previous slide, Sue? So here's something that I didn't point out before, but this speaks to position sizing. One of the things that I've learned in my journey as a trader is that most people trade too big. I did that when at one point I put my whole portfolio into one stock, okay? Because it was the 2008 crisis, and my logic was, well, it's paying me a dividend, duh, right? It's paying me a dividend. It's everything else is performing like garbage, so this is what I'm going to do. And I didn't have any rules to get out, and I didn't have any rules for anything. It just looked good to me, right? But one of the things you have to realize, the maximum consecutive winners and losers. So you can have up to 23 losers in a row. If you do not have the proper position sizing in place, you're going to get creamed. Doesn't matter how good your system is. If you trade too big, at some point you're just going to hit your maximum risk of ruin, right? Risk of ruin is just from a string of losses. It's just going to kill you. So it's important just to be aware of that and to pay attention. That's why, when we set up the portfolio test, we're doing 20 positions, 5% per position, right? Because you're going to have times where you're going to have a string of losers. It's statistically inevitable. Okay, sorry, go ahead, Sue. Okay, you can go to the next slide, please. Okay, so now the directional movement index. I like this because this is kind of like my last name, DiMarcantonio, and we can call this industries. So the DMI, so all we're really doing is we're buying when the green crosses the red. So the green is the DI plus, the the red is the DI minus, and we're selling when that happens negatively. So obviously I cherry picked the winning trade here, buy, sell. Okay, go ahead, Sue. Yeah, so DMI 14 crossover when the DI positive crosses over the DI negative and vice versa. Okay, so you can look, this equity curve doesn't look that nice, does it? Right, you can see some major peaks and valleys. I did investigate this. I just assumed it was accurate because this is 2008. But I mean, when you see that, you could have a rogue trade in your data. But I think that's probably pretty accurate. But if you look at it, it still has a slightly positive expectancy. Now, keep in mind, if you add commissions in here, that expectancy could be negative, right? So we're just making assumptions there's no commissions. It took 10,500 trades, minus 73% drawdown. Oh my God, my knees are getting weak. So, 27 max losers in a row. I mean, what can I say? The data speaks for itself. It's still positive, but it's pretty ugly. Now, a lot of people, what they do is they say, hey, I started trading here. I've got an awesome system, right? Look at my equity curve, because they usually show you this part of the chart. Look at the back test on my equity curve. But if you look far enough back in history, you're going to find that maybe your system isn't as robust as you thought it might be. Next slide, please. Okay, the all trades test, expectancy 0.38, 258 losing trades in a row, minus 50% drawdown. We had about 300,000 trades almost. Okay.
You ignored the ADX portion of this, right?
Well, hold on. So in this test, what I did is I said, well, the ADX tells you things are trending, right? So why don't we figure out if maybe if we add the ADX component back in, if it's going to give us a better result. So what we did is we optimized the ADX, ADX 14, and it optimized greater than 41, right? So same rules, except that now it's like we're going to buy when there's a crossover and when the ADX is greater than 41. Go ahead, Sue. So the equity curve's still ugly. I mean, if it was a girl, I wouldn't date it, right? It's pretty ugly. That was a bad analogy. I apologize. But you can see it has a positive expectancy. The expectancy went up to 0.88, and the drawdown went down a little bit quite a bit, to minus 26%. And the CAR MDD is about 0.12.
And look how good 2008 is compared to the other one.
Yes. Yeah, because that's I don't have an explanation for it, but yeah. Okay. Do we have any questions out there in the internet land? Are there any questions before we go forward?
Yeah, we're good.
Great.
In your equity curve chart, there seems to be a black line in that 2009. Is your data hole or?
No, I think that's just I had the cursor there or something. I'm not sure, because I was just grabbing screenshots. Yeah. Okay, so this is the DMI. Okay, can we go forward a bit? Okay, does anybody use the Arun? Arun? No, I probably shouldn't have included this because I've never used it either. The reason why I did, sorry? Oh, okay. The reason why I did include it is because there was a really expensive newsletter from somebody out there in the newsletter realm, and they were basically saying that they use this indicator and their system is the best, as usually you hear, and they wanted $5,000 a year for a subscription. So I said, well, you know what? Being a nice guy, I'm going to trust them, but let me verify it, right? Because that's kind of my motto. Let's trust but verify. So we took a look at the Arun indicator. Go ahead, Sue. And so here's a cherry pick trade. It looks a lot like the DMI, right, where you get the crosses. Same idea, right? Buy and sell on the crosses. Go ahead, Sue. So the rules are very simple. Go ahead. That's what the equity curve looked like. So let's see, 58% drawdown, 0.66% expectancy, average return about 7.5% a year. I mean, the equity curve looks great, but again, 2008, that's in our test, that's our worst case scenario, right? Our maximum drawdown. Okay, go ahead, Sue. Thank you. So all trades test, 0.49 expectancy, it dropped a little bit. Maximum system drawdown, I think it went up a little bit. It's minus 60%. Go ahead, Sue. Okay, so let's look at the MACD. Who uses the MACD? Come on, I know there's a lot of closet MACD lovers. Thank you, Bill. Okay, so the MACD, we're just going to buy and sell on the crossover. So here's an example. So we didn't pay any attention to whether it was above the zero line or not. I've tested some systems where, actually, I remember the system I developed for you, Doug. There was a system we presented it at JB's group where we're buying CCI pullbacks, but only when the MACD line was above the zero line. And to be honest with you, the results were pretty decent, right? Because what I find with the longer term oscillator like a MACD is it will tell you when the market is actually positive and trending when it crosses the zero line. So for example, the last couple of days I'm looking at the market, I look at the 60-minute chart and I look at the daily chart, right? Multiple time frame analysis. When the MACD on the 60-minute chart crossed the zero line, usually I have a pattern confirmation that the market's going higher. It could be the break of a downtrend line, the breakout of a channel, could be a 1, 2, 3 trend change for anyone who's aware of what a 1, 2, 3 trend change is. If you're not, write that down and look it up on Bukowski's site. It's a good pattern to know for macro market direction. But a lot of times when the MACD crosses the zero line, it will usually confirm some kind of pattern you're looking at too. So, but we didn't test that. All we tested, we just wanted to see if when the MACD crosses over positive and negative, what the results look like. Go ahead, Sue. So, okay, I kind of got ahead of myself. So again, you can see 2008 was a hard year for MACDers. The maximum system drawdown, 70%. Compounded annual returns a little bit higher at 11%. Who would be happy with a consistent 11% a year? Okay. So expectancy 0.66%. So I mean, it doesn't look bad. The CAR MDD 0.16. I mean, the equity curve looks pretty decent, except for 2018. Go ahead, Sue. So for the all trades test, we had 257,000 trades, expectancy 0.36, maximum drawdown 59%. Okay, go ahead, Sue. Okay, let's look at stochastics. Now, with stochastics, I took two approaches. The person who actually got me really interested in stochastics again, and I'll say again because when I first started looking at technical analysis, I used stochastics and then I didn't know how to use them properly, so I just kind of threw them out, right? Because I wasn't systematic, I wasn't quantifying things at the time. So I kind of threw them out. So one day I was having a conversation with Don Vialou. Everybody knows Don, right? And Don was saying, we were talking about seasonality. And he said, when the stochastics roll up, that's a really nice signal. And sometimes you just get these little gems that people throw out to you. People that are in the know, and they throw them out to you, and that got me thinking. So I started using stochastics and I started looking at them. So what I did was I did a test to look at the crossovers. Now the crossovers, it doesn't matter where the crossover took place. So if it happened in the bottom of the oscillator range, in the top of the oscillator range, it doesn't matter. They're just crossovers. The roll-ups are a little bit different. So the roll-ups are, actually, can you just go forward? So let's first talk about the stochastic crossover. Go ahead, Sue. And then we'll get into the roll-ups. So this is obviously, I cherry-picked this one. You had a roll-up from an oversold level, and you sold at an overbought level when it crossed back over. Now, this could be a signal here. That could be a signal to sell. This could be a signal. That could be a signal. So you're going to get a lot of whipsaws, right? So the way that we tested this, we just took every crossover. Okay, so let's just be aware of that. This just happened to be the perfect kind of stochastic you want to trade, the stochastic setup. Go ahead, Sue. So again, the rules: buy when the stochastics cross over, sell when they cross over again. Here's the equity curve, looks a little bit uglier. The expectancy is 0.05, so I suspect that When you add commissions in there, you're actually going to have a negative expectancy. Minus 74% almost. Drawdown. The car MDD is like 0.01. It's basically non-existent. So, I mean, that's what that looks like. So let's look at the next slide. And the results are essentially the same. I mean, they're ugly. Go ahead, Sue. So let's look at the roll-up now. So the roll-up is when we get a buy when it crosses up above a certain level. So for example, let's assume our level is 10. In this case, it's actually not. But if the level is 10, then let's say it's below 10 and then it crosses 10, that's a buy signal. When it gets to our oversold level, that's a sell. Is that clear with everybody? Okay. So go ahead, Sue. So it optimized when the stochastic is oversold below 1. So that's pretty oversold. Okay. When it crosses above 1, that's a buy signal. That's what it optimized at. And then we sell when it crosses over 31 again. Okay. Go ahead, Sue. So this looks pretty good. I mean, that's a pretty nice equity curve, right? That's a pretty nice equity curve. Our expectancy is almost 2% per trade, which is pretty good. Our maximum system drawdown is only about 20%. That's a lot better than most of the other tests. Our car MDD is 0.43. That's approaching something that's tradable, okay? Without any other rules, right? Without any other logic. So now notice we only had about 1,846 trades. Can somebody do the quick math? Divided by 18 years, that's 100 trades a year? That's not bad. How many people do 100 trades a year in the room? What do you think?
That's 50 round trips.
Well, it's actually 200 round trips, right? Because it's 100 trades a year. So it'd be 100 buys, 100 sells on average. Okay, so this is so the point I'm just trying to make is I don't know what everybody's frequency of trading is. You know, some people like to trade in and out. Other people like to be longer term investors. So you have to kind of look at your total trades to see, is this something you're going to be comfortable with? If you're comfortable doing 100 trades a year, then, I mean, in relation to the other signals, this is a slower kind of moving system, right? And that's an average. We could pull out the metrics and see exactly how many trades it did every year using the ME broker logic. So, but if you look at that, that looks pretty good. Okay, so I'm just going to keep a mental note of that one. Go ahead, Sue. Sure, go ahead.
Which stochastic did you use?
I think can you just go back?
433.
So I used the 1433. Yeah.
And Dave, on back to the performance chart there.
Sure.
The next one.
Yep.
Just speculating, why is 2008 so good?
Yeah, 30%.
There were some drawdowns. I honestly don't know. I'd have to actually look at the data a little closer. I know that the logic of the test worked because I took samples of the test to make sure they were working. I honestly don't know. It could be that it could actually be that things stayed oversold. I'm just speculating now. Things stayed oversold for very long, and when they actually bounced, you got enough of a bounce to get out of the trade and make a profit. Because when things get really oversold, I mean, bull market rallies are pretty fierce. So maybe it caught a couple bull market rallies. I mean, I'm speculating. We'd have to look deeper into the data. Sue, go ahead.
So what if you added a filter where you said, I'm only going to take trades, I'm only going to implement this when the bigger MACD on the monthly, stochastics, is working in my favor. So I've got the monthly curving higher, and then only stocks that qualify with that monthly curve up, am I going to employ this?
You could absolutely do that.
Because that would improve your results, I would think.
It might. But see, so here's the thing. When you, like I said at the beginning, you can go into some pretty deep rabbit holes when you start doing this stuff. I think some of the guys like Omar, can you attest to this? You can start going into some pretty deep rabbit holes when you start saying, well, what if I do this? And what if I do that? And I mean, I've gone on little journeys for like a week at a time where I'm just doing this all day long. Right? So sometimes the results surprise you. Yeah. Right. So, but I like that comment, Sue, because what it tells me is you're thinking systematically. So when you start thinking systematically and you start thinking, I should quantify this stuff. You're on the right track. So that's great. Was there a comment or a question in the back?
That was just your 2008, you had 2 months that were spectacular, 15, 16% in there. That's probably why that year survived.
Yes, it could be right before the crash. Yeah.
It's over.
It was during the crash.
During the crash.
November.
15% to 16%. That's why. That's why
Okay.
it was going down.
So like I said, I don't want to focus too much on the details. Let's keep this kind of high level. I'm going to give you all a copy of the presentation. You can rip through the data and we can have a conversation offline about it. That would be great. Okay, go ahead, Sue. So, okay, expectancy looks pretty good. It's over 2%.
Drawdown was only 2%.
Yeah, see, that's not an accurate number. I don't think that's an accurate number. And sometimes the way that the software does the calculations, certain data is not reliable. So the only thing I really rely on is the win rate, the average profit per trade, the loss rate, the average loss per trade, and the expectancy. That's the only thing I rely on it for. I just want to see if those are in alignment with the portfolio test and if that gives me a baseline on how it's performing. So that's why I said you have to be careful with some of these tests. That, Gordon?
So this is 2,300 trades. Go back to the other slide, it was 1,800 trades.
Yes. So it's slightly more.
Just 300 more trades.
Yeah.
500 more trades.
That's not typical. Most of the other ones are in the hundreds of thousands. So that's definitely not typical because it optimized at a really oversold level. And that's not something you really catch that often. I mean, I've never caught it in a chart. Like, oh my God, it's at zero. The stochastic's at zero. I have to buy. I've never seen that personally as a discretionary trader. Okay, go ahead, Sue. So moving average crossovers using exponential crossovers. Here's where things get a little bit weird, guys, if they're not weird enough for you. Here's where things get just a little bit weirder. Just want to do a quick time check. So we're at 8:30. Is everybody still good? Okay, so here's where things get a little bit weird. Go ahead, Sue. So this is what a technical analyst would expect a moving average crossover to look like. Go ahead, Sue. Right? You get a moving average crossover, you buy, you get a crossover negative, you sell. That's what you would expect it to look like. All right? So go ahead, Sue. So this is what the optimized crossover system actually looked like. So what I did was I optimized from 1 to 200 for each of the fast and slow EMA. This was like the optimization took all night. Go ahead, Sue. So here's your buy, and here's your sell. So when your when your slow moving average crossed over, you buy, and when your slow moving average crossed back over, you sell. So that when I first did this test, I ran it like 30 times, and I think this is broken. Something's wrong with this because I wasn't expecting this. Go ahead, Sue. So I call this the moving average crossover anomaly. So when you're optimizing values, a strange thing happens. So the best values were actually inverted. So for example, the best optimized values were the fast average was 11 and the slow average is 1. Right? So for some reason, the opposite of what you would expect happens. Now, a possible explanation of this is what I call like a rubber band type trade or a reversion to the mean market characteristic. I've done a number of tests on the market to test for short-term reversion to the mean. And the market absolutely demonstrates reversion to the mean characteristics that are profitable, right? That's why in my own trading, I buy pullbacks. I don't buy breakouts. I only buy pullbacks. And in that presentation today with Larry Connors and Cesar Alvarez, they were talking about, they didn't talk about the 3 types of trading systems, but they did talk about, like longer term, you typically want to trend follow. In the short term, you typically want to, buy pullbacks. You want to do reversion trading in the short term. So if you're a shorter term trader, you probably should be buying pullbacks. If you're a longer term trader, do trend following. I consider that the market has another characteristic that you can exploit, and that's momentum. So when I talk about like you want to be systematic, you want to diversify your trading systems. We haven't really talked about that, but one of the things you really want to do is you want to look at different characteristics of the market, and you want to diversify your approaches so that you can smooth out your overall equity curves. So for example, my goal is to have, now I like to automate. So I have an automated reversion to the mean system right now that it works for me like an employee that I don't pay. And it just does, it takes trades every day, right? So it buys pullbacks. Then longer term, you probably want to have some kind of trend following system. And then sort of midterm, you want to have some kind of momentum system. So I think those are the three characteristics of the market that you can build systems around, okay? Without getting like keeping it high level, not getting into specifics. So I think what happened here with the moving average crossover, because I've tested different reversion to the mean systems, this is like a reversion to the mean system, right? You're buying a short-term pullback that resolves itself higher typically. Go ahead, Sue. So again, this is just kind of for the sake of anyone who wants to study this. I've just kind of documented it. But you can have some pretty ugly market action.
There's one EMA, it's really sensitive.
Yeah, and that's what it optimized at, right? But if you actually look at the optimization results, the first maybe 6 to 10 are all inverted averages. And then you start getting into the next slide where you get, okay, so we covered this. You can go forward. Okay, let me get back to that point. But what I was going to say is the next results you get into are what you would expect to be the proper crossovers, where you get, the short-term moving average is going to be 36 and the long-term is 46. So I just wanted to show a couple of things here I've highlighted. You had 23,000 trades, 0.32 expectancy. So again, if you start throwing commissions in there, it might fall apart, okay? Because the expectancy is really low. Maximum system drawdown, 50%. CAR MDD was still fairly high. The equity curve actually looks pretty good. Okay. Go ahead, Sue. Thank you. So, here's the all trades test. It's pretty much the same. It's pretty close.
Lots of trades.
Lots of trades, almost 600,000. Right? Yeah. Well, you're just, it's just crunching the data, right? Go ahead, Sue. Thank you. So let's review the optimized results of what you would expect from a normal EMA crossover. Go ahead, Sue. So when we did the optimization, we had 36 and 46. So we're going to buy on the close when the fast crosses the slow, as you would expect. 36 EMA crosses a 46 EMA on the daily chart, and when the opposite happens. So this is what it optimized at for the kind of results that you would expect. I think it was like 6th or 7th or maybe even 10th on the list. But this would be more like a trend following system because you're going to get slower action, right? This is more longer term trades. Can you go to the next slide, please? You only had 2,400 trades over the 18 years. Look at your expectancy, 4.07%. But there's basically two types of system results I see. This is probably a good time to talk about this. You're either usually going to see a system that has a lower win rate like this, 36%, but you're going to get a high expectancy number, right? You're going to get like an average profit of, see here, you get 26% for your winners, and for your losers, you're only losing 8%, but you're only winning 36% of the time. So I tend to lean towards more those kind of systems because your execution doesn't have to be expert, right? You don't have to have expert, high frequency trading system kind of execution to make money with systems like this. And the reason why is because you have enough wiggle room. You have enough meat in your winners to cover any trading errors, slippage, trading mistakes, all of that kind of stuff. The other kind of system you're going to see is you're going to see systems that maybe have a really high win rate, and they're going to have a lower expectancy. So maybe you get a system that has an 80% win rate, right? But it's typically going to lose. It's typically going to make it's going to be inverted. So it's going to make 8%, 8.5% when it wins, and it's going to lose 26% when it loses. But because you've got an 80% or a 90% win rate, you think it's great. The problem with systems like that is unless you have a super high frequency expert trading system that can execute, not make mistakes, is not subject to slippage, they're very difficult to make money with. So I tend to try to find my balance more on the higher profit, lower win rate kind of systems. I think my system wins 35 to 40% of the time in real time, but it usually makes a lot more when it wins than it does when it loses. And I'm comfortable with that because I know what to expect.
Don't you get discouraged
No.
at that win rate?
Sometimes, like when we went through this last drawdown, I'm not going to say the reason why I went to automated trading personally is to remove some of the emotion because I'm not a good trader when it comes to dealing with my emotion. So you can either spend thousands of dollars and hundreds of hours trying to get your psychology in play, right, in place, or you can just say, hey, I know what to expect because I've done my homework and I'm okay with that, and I'll just let the system do what it wants. Right? So what your average drawdowns are. You get tested, you're going to get tested. Like I got tested with this last pullback. And you start saying, well, should I turn the system off? Should I do this? Should I do that? You go back to your back testing results and you start saying, well, this is a normal pullback according to my back testing results. And you start looking at these things. It's not to say that your emotions don't get tested. It's not to say that you're not on the fence and you're not a little bit jittery, you're not a little bit shaky, like you had about 5 coffees too many that day, but it happens, right? And if you know what to expect, then you can manage the psychological aspect of trading much better, right? So that's kind of the realm that I've stepped into in my journey to try to be more systematic, quantified, and automated, right? Because that's the direction that I've decided to go. Is to automate my trading.
Dave,
Okay. Yes.
how did you draw the distinction between your short moving average anomaly oriented piece and the longer term 35-35? How did you draw the line in terms of where to flip from one system to another?
I'm not sure if I'm going to answer this correctly, but what I did was I just optimized the values, and those are the values it came up with. Does that answer your question?
So you tested all the combinations from
Yes.
1 to 200.
That's right, for both averages.
Numbers all the way across the board.
Yeah.
And then the ones that you thought were working best using the anomaly approach or the inversion approach.
No, what I did was, okay, I understand the question. Sorry. So what I did was, I'm optimizing according to my car MDD, right? So what happens is it's going to give me a list of all of the best performers in the optimization report. So I looked at all the ones that were inverted and I presented the results for that one prior. The first one that was not inverted, where you had the actual lower EMA and the higher EMA as you would expect, became my best result for this test. Yeah, because you can't get around that inversion sort of process when you optimize.
So when you rank ordered them based on the car
MDD, yeah.
MDD, when you rank ordered them, you had a mix of things in there at the top
Yes.
of the list. Some were short term and
That's
some
right.
were long term, and you just sort of split them out. Here's one general approach.
Yeah, well, the first group of results were the inverted results, the anomalies, and then when I got to the proper, well, what you would expect were the proper results, this was first on the list. Yeah.
I discovered this inversion thing by accident, and I thought it
Me
was
too.
because I didn't know what I was doing.
Me too. Me too.
And I banged my head on the wall for about a week.
Yes. So I kind of went through the same process. So this is the thing when you decide to become more quantified in your approach, you're going to discover things that sort of break conventional wisdom, and it's going to force you to explore these things. And Steve's been on that journey. I've been on that journey. It's part of the process. It's a beautiful process. Okay, so here's the all trades test. The expectancy dropped a little bit, but much as you would expect. You've got pretty good system drawdown. Go ahead, Sue. So now we're going to look at did I spell that wrong? Chicken?
That's correct.
Okay. Maybe I spelled it wrong initially. Okay. So the Chaikin money flow. So what we did, go ahead, Sue. So this test is just based on a simple crossover. So what we did is we bought on the on the crossover the zero line, and we sold on the crossover the zero line. Obviously not the most optimal way to trade it probably, but these were the rules that we chose. Go ahead, Sue. Okay, go ahead. So here were the results. 60% drawdown, 0.7% expectancy, 6,300 trades. And I mean, what can you say? The car MDD was really low at 0.08. Go ahead, Sue. The all trades test, much the same. You know, you've got a 0.53% expectancy. I mean, it's you have 161,000 trades, win rate of 38%. Go ahead, Sue. Next. So now we're going to look at the MFI, the money flow index. So the money flow index is kind of like a volume weighted RSI. So we're going to buy when the MFI 14 is less than 25, and we're going to sell when the MFI 14 is greater than 47, much like the RSI setup. Okay. So the equity curve looks pretty good. You've got some decent drawdowns. You've got, so if you look at it, the results actually look not too bad. I mean, you've got a compounded annual return of almost 17%, an expectancy of 0.78%. You did 11,000 trades, 63% win rate. That's pretty respectable. And then if you look at your maximum system drawdowns, about 60%. Your car MDD was 0.28, so it was on the higher range of what we've been testing. Go ahead, Sue. So the all trades test, the expectancy went up a little bit, which is good to know. 74,694 total trades, and maximum drawdown about 41%. You're still going to have these strings of losses, 63 losing trades in a row. Go ahead, Sue. Okay, so let's talk a little bit about the summary. Now, I have a number of different summaries in here, so this isn't the end game. So recall my objective function, right? So if you focus on the car MDD, it makes a starting point of comparing all these numbers and all these systems much simpler. And that's really the goal here. I want to keep this high level. I want you just to understand how you can be a little bit more quantified, a little bit more systematic in your approach. And I think that technical analysts are in a good, unique position to lead the way towards being, more quantified in their approach. We're essentially part artists and part scientists as technical analysts, and this kind of leans a little bit more on the science side, right? A little bit more on the statistical side. And I think that as technical analysts, we should embrace this going forward. I think, everything changes over time, things evolve, and I think this is a good way for TA to evolve. A couple of years ago, we were talking about the fusion of fusion analysis, where you're overlaying fundamental analysis, technical analysis, and other things. So I think this is just an evolution of technical analysis, and if I can sort of prod you in that direction, if I can influence you a little bit to be a little bit more quantified and systematic, I'm hoping that happens, okay, because I know it's been beneficial for me. Now, okay, so I got a little bit off track there, but if you focus in on our objective function again, which was subjective to me, it makes things a lot simpler. So each trader or investor, as mentioned, they may have their own objective function, which is subjective to each individual. Okay, I just want to reiterate that point. So go ahead, Sue. Thank you. So here's a summary, and I'll just simplify this a little bit for you. So here's in my software, if I run one test after the other, it spits out a summary of my trade reports. And then what I can do is I can simply either bring it into a spreadsheet, or I can just sort it in my report explorer. And what I did was I just basically sorted by the car MDD. If, let's say, your objective function was expectancy, well, you could do the same, right? In this case, no, we didn't have the highest expectancy in the top score, but that could be your sorting kind of criteria. So here we want to focus on the MAR ratio. That's my objective function. Now, just a note, if the expectancy percent is low, so low expectancy numbers are a risk for losses due to commissions, slippage, and market action. So the question you have to ask yourself if you have a low expectancy percentage is, are you making enough on average per trade between your winners and your losers? Okay, that was a point I brought up earlier, but I put it on the summary sheet here because it's important. It took me a while to figure out how to analyze data and just kind of simplify, because I'm not a complicated thinker. I like to break things down into the E equals MC squared, the simplest equation, the simplest, just the simplest kind of analysis. I'm not a complicated thinker. I like to simplify things. So when we're testing and considering trading systems, as I mentioned, I'd like to see a CAR MDD of at least 0.5 to start, preferably after commissions are accounted for. That's important because I think that'll give you a good baseline if you ever decide to sort of get into this a little bit deeper and go down those rabbit holes. It took me a long time to figure out that this was sort of a good threshold to look at. So if we were to rank all of our tests, so you can see test run number 17 was the anomaly. And since it didn't really achieve our objective, and it's not really in alignment with what we're trying to do, and it has a low expectancy, I just threw it out. I threw it out of the results. So the best results based on that were the stochastic roll-up, the MFI, the EMA crossover, the CCI, and the RSI. Those were the best results. Okay? Go ahead, Sue. So, summary part 2. So is that the end of the story? Well, not really. So if you recall, we attempted to remove the rank bias using a different position score that it really gave no preference to market condition or relative strength. Now, in practice, how many people here usually trying to find, if let's say you're trying to find a trade and you have, how many people here use scanning? Let's start there. How many people use scanning to find trades? Sue? Okay. How often do you actually get to a day where maybe you have 5 or 10 potential trades? Every day. And maybe you only want to put on half of that or even less, right? You don't want to allocate that much capital or that many positions, because when you're not automated, like Sue's very systematic. Sue is what I would call the definition of a systematic trader. She has a defined system. She has the confidence to understand it and to follow through with it. She has the consistency, which is needed, right? So Sue is a systematic trader, but she may find lots of signals and she's trying to figure out, well, how do you decide which is the best signal to trade? So in practice, most people will rank the signal, right? You'll find some way to decide or give preference to one trade over another. So we call that ranking. In AMI Broker, there's a function called position score. So for example, what this says is when I want to rank all of my signals, my position score is going to be equal to the rate of change over the last 60 days. That's what that says. So essentially what it's going to do is it's going to say, okay, I'm Sue, I've got all these signals. What do I trade? Well, if I go according to my position score ranking of trading the strongest stocks or the stocks that have changed the most in a positive manner over the last 60 days, it's going to give me a list of results. They're all going to have a valid crossover signal or valid RSI buy threshold, whatever our signal was, but it's going to rank that universe of signals in stocks in a way that's going to give me preference of one signal over the other. Is that clear? Okay. Sometimes I ramble, so just let me know. Okay, so when we do that, so now look at our results. And I personally think this is a little bit more realistic. I know in my own trading, I try to come up with the best sort of algorithm to decide which signals I want to give preference to. So in this case, we just did a very simple position score ranking of rate of change over the last 60 days. So the best results were CCI, MFI, RSI, stochastic rollup, and then MACD. In my own trading and testing and things like that, that's what I would really expect, right? All of these kind of overbought, oversold indicators, they work pretty decently. And if you're going to look at a short-term reversion to the mean system, I think that those top 3 indicators and even the 4th, the stochastic rollup, I think are good choices to look at on your journey to developing a robust system. Now, when I say a system, it's just, you're just trying to figure out some trading rules. It's not complicated. The less rules you have, the better. It's better to keep systems simple. That's another thing that Larry Connors and and Cesar Alvarez discussed today is they try to make sure that you don't have a lot of rules. Howard Bandy, I think, calls it the curse of dimensionality because he likes complicated terms, I guess. But usually when you have a lot of rules and a lot of things can go wrong. You've got to optimize a lot of parameters. You don't really want that. You want to keep your rules simple. You want to keep your system simple. You don't want them to be able to break easily. You want them robust, right? And that usually happens when you have simple rules. And I mean that's kind of what I've discovered over my journey over the last few years doing this. But if you're looking for something as a starting point to develop maybe a system that works for you, those are good choices for technical indicators. I like them all, to be honest with you. Okay, go ahead, Ken.
If you combine indicators, so that's a different.
Well, beware of the curse of dimensionality, right? You don't want to have too many rules. Now, having said that, you brought up a good point. I like to combine these kind of indicators with a slower moving oscillator like the MACD. Like I had mentioned, I did a test on Doug's system because we were trying to help Doug and JB's. JB runs a monthly system meeting in Burlington, by the way. So if you're ever interested in learning about systems and things like that, JB runs a really good meeting in Burlington every month, and there's free pizza if you pay to get in. And the pizza's great. Pizza's fantastic.
Told me it was free. I thought it was paid.
Well, you have to pay to get in the meeting just to support the cause, but then the pizza's free. So, and I also run the AMI broker group every month. We don't focus as much on systems. We're more focusing on how to use AMI broker as a tool to do some of this stuff. But JB's group focuses more on systems. So in one of those meetings, we were talking about, well, does anybody have any rules? Do you want us to verify them? Do you want us to quantify them? Do you want to know if it works or not? And Doug stood up. Maybe he didn't actually stand up, put your hand up and said, well, I look at this and I look at that and I'd like to kind of know. So I kind of took everything that Doug said and I simplified it from, 5 or 7 things that he looked at to 2 things. And I just looked at the CCI and I optimized what's the best CCI and can I combine a short-term oversold with maybe a longer-term oscillator like the MACD. So I combined those 2 oscillators. The results were pretty good, right? The results were pretty good. It was a longer-term trading system, so you didn't get a lot of signals, but it was pretty good. It was more if you're sort of like a longer-term swing trader or let's say a longer-term swing trader or an investor position trader, that it would be pretty good. If anybody wants a copy of that presentation, send me an email and I'll send it to you for study.
Comment. I found with the CCI, the RSI, and the MACD, if all those signals work together, that's your best, the best signal. You can get all 3 crossovers to work, and that's your best time.
Right. If you think about it, a lot of these indicators do a lot of the same things. They're all calculated based on price. So, right.
Yeah, they're all the MACD is a lagging indicator. So
yes. All indicators are lagging indicators.
So,
all
yeah,
indicators.
the CCI is the quickest, and the RSI is a little bit more robust,
right.
I find.
Yeah, I mean you can adjust. We did all these values based on the 14 because that's what you find in most of the literature. But you can use a CCI. I think we optimized yours at a CCI 13.
I went to 13 because I used
right.
an MA of 13 and 40.
Right. And I did a presentation, I think it was in January of 2017 to the CSTA using the RSI2. That's a system that Larry Connors and Cesar Alvarez came up with. So, you get lots of signals, but it's a pretty good system, right? If you want to trade like that. So, you're just buying a short-term overbought condition. So if I can just make a note, if you're ever interested in developing a system, the way to start is to observe how the market behaves. And when you observe how the market behaves, all you're really trying to do is quantify programmatically with rules if you can capture some of that behavior. For example, I always start from a very high level and I say to myself, okay, I know the market likes to pull back and it likes to stair step. How can I define those stair steps, right? Because I know when it pulls back, it usually resolves higher, right? I know that the market exhibits trend following characteristics. How can I define that? I know that the market exhibits momentum characteristics. How can I define that? So, a lot of people are just looking for esoteric, crazy rules that are like nobody else knows. But it's really not that complicated. Now we're getting into an era of machine learning and all kinds of other things, and maybe we'll have a different discussion in 5 or 10 years as I learn more about this stuff. But for now, trust me, it doesn't have to be complicated. So, are there any questions about the best results based on this?
I'm really not familiar with CCI.
Okay.
It is a crossover.
No, it's a momentum indicator similar to the RSI.
So typically you buy it when?
So you buy on over. I always mix these up. Yeah, minus 100 plus 40 is what we optimize. Yeah, so you want to buy it when it's oversold, sell it when it's overbought, essentially.
When it's down below minus 100, you want to look at buying it. And generally, when it's over plus 100, you want to look at selling it. That's the rough rule of thumb.
That's what we optimized at.
Different
Yeah.
levels.
And that's what our results, your results there optimized at.
Yeah, and you'll have a chance to study this. And if you have any questions, because I know you're probably going to need some time to process this, send me an email and we can talk about this stuff. JB?
I must mention that there is better rules.
Sorry?
There is better rules.
Oh, absolutely. Listen, guys.
That's just the minimum rules.
Exactly. These are minimum rules just to run a test, right? For comparison. Because remember the objective of this exercise was to look at what the historical literature kind of talks about with indicators and to see if they actually have an edge and what to expect from these indicators. This is really a starting point just to kind of look at that and start a conversation and get you thinking about being more systematic and more quantified. That's really the objective of this presentation. The objective is not to say, here you go, here's a silver platter, here's your trading system, God bless. Right? Put your kids through college. Like that's not, sorry?
Is that the January meeting?
That's a January meeting. That's not the objective of this meeting. The objective of this meeting is to get you thinking about technical analysis in a more quantified manner. Sorry, Sue, can you go ahead? I think we can get close to wrapping this up. So as you can see, I love this slide, guys. As you can see, this explains absolutely nothing. I love this slide because when you go through all of this data. Sorry, gentlemen, I just kind of want to wrap this up. Doug? Sorry, it's okay. I just kind of want to wrap this up. So this is a summary of everything I just showed you. This explains nothing, right? This is a starting point. Go ahead, Sue. Okay, so let's wrap this up. So based on my own experience in working with system testing and development, I tend to trust the latter, summary part 2, which I already mentioned. So why would I do that? So in the real world, traders tend to attempt to achieve an edge through some form of giving their active trade signals preference of some kind. Not in all cases, but in many. I know some guys who do some pretty crazy stuff and they actually randomize everything because they want to know that their systems are robust. I personally wouldn't do it. I don't understand it. They have great success with it. It takes all kinds of approaches to make the market go around, I guess. So they want to give their trade signals preference of some kind, not in all cases, but in many. So some signals are better than others appears to often be true. At least that's my experience. So changing the overall signal logic, as in this example, it may change and affect your overall performance stats of the test script, and that needs to be a consideration. So in this example, the ranking algorithm changed our results, right? And that's typically what you're going to find. So that's why I suggested when you're trying to develop a system, find something that is robust and that is defining well the philosophy that you have in the way the market works, and just kind of focus on that. Okay. And then when you start adding other macro market filters, you start adding other things to the equation, it won't throw you off track because you're trying to achieve a certain objective, right? You're trying to define the way the market works or your understanding of how the market works and trying to exploit an edge in that. So what ultimately matters is that the technical indicator that you're used, it's in alignment with your methods, your goals, your objectives, and your expectations, and that it works sufficiently well within the context of what you're trying to achieve. I have to read this because I can't remember all this stuff, guys. Also important to understand what to expect, okay? And to me, that I've highlighted that in blue. It's important to understand what to expect. That changed my whole concept of trading because unless you know what to expect from your results, from your system, you don't know if you've burned through 20 good trading systems that you just couldn't hang on through the bad times. You might have had really good systems that you just decided to walk away from, right? Because you just didn't know what to expect from that system. It had a 10% drawdown. Oh my God, I can't do this anymore, right? And you moved on to something else. So what you really need to figure out is understanding when you start to get more quantified and start to become more systematic is what can you expect from your system? And usually that's a process through the back testing procedure. Okay, we didn't really talk a lot about that today. Go ahead, Sue. Okay, so we've got multiple summary points, and I just want to get like some key thoughts across here. So major observations. Most indicators show positive expectancy and work decently in the good market years, right? It was usually things fell apart in 2008, right? So the challenge in extracting profits from the market on a consistent basis is in being consistent with your plan, being consistent with your methods, being systematic and quantitative, right? And figuring out a way to filter out when not to trade. For example, 2008, you might have a condition that defined that maybe you should stop trading your system, right? And I'm not going to tell you what that might be. I'll leave that up to your imagination. I have ideas for that. I've incorporated some into my own trading system. It can be done. That's all I'm going to tell you. I'm going to encourage you that it can be done. So these indicators provide an interesting and potentially useful starting point into building more complete and robust systems. And that was the point of the exercise. Those systems would appear to require ways to determine when to stay out of certain market regimes, okay, and consideration in how to limit excessive drawdowns. Because excessive drawdowns are going to kill you in terms of your trading capital, but they're also going to destroy your trading psychology. So in order to be able to stay the course and stay in the game, you need to find out and you need to study ways and considerations on how to limit excessive drawdowns. To me, that's one of the most important things. That's why my objective function is the CAR MDD because it takes into consideration maximum drawdowns. Okay, so go ahead, Sue. How many more observations do we have here? Let's just see. Okay, so ranking observation. So ranking, or the method used to determine which trading signals to enter first, may have a significant impact on individual backtest results. And we did mention that. So one way to potentially increase returns is to rank signal preference by some measure of market strength, such as rate of change. That's just one example. But, excuse me, you have to be careful that your signals are still valid and that performance isn't just from the chosen ranking algo. Okay, so it's always good to sort of, start with your base test like we did here with an indicator and say, well, does it have a positive expectancy? Well, yes, it does. Now, what if I start adding a ranking algorithm to it, right? What if I decide to have better preferences in how I decide to rank my signals? How does that affect my results? Okay, that's great. Now it's better. Now, hopefully, now what if I add in a market filter and I start saying things like, I don't want to trade when certain conditions are in play. For example, we're below the 200-day moving average. I don't want to trade. How does that look? How does that affect my drawdowns? So that's how you start to develop a system. And you really only need like a few robust rules and simple rules in order to define what you're trying to do and in order to figure out if you have a good trading methodology. Now, if you're a really good trader and you have a system like that and you've got really good instincts, and I define instincts by saying that you've spent over 10,000 hours looking at charts, you're sort of a technical analysis pro, you just got a feel for the market, you're in tune with the market, you can overlay that knowledge with your signals and say, well, I don't want to trade because I know something. My intuition is telling me something. My instincts are telling me something. I've seen this before. Your brain is like an inference engine where when you see enough things, you can sort of intuit if things are worth doing or not. If you've got that kind of instinct, you can overlay that also on top of your system, right? It's just another decision-making process. I personally don't because I don't trust myself. Okay, so because sometimes I just it's recency bias, cognitive dissonance. There's all kinds of reasons why You may not want to do something like that, but if you're really good at it, why not? So it's still being systematic. It's just defining that and working around that. So the rate of change, you can use that for a ranking algorithm. So in this example, stocks that have performed better over the past 60 or 90 days relative to other stocks will be given trade priority. So that's kind of how that works.
If you don't stipulate a ranking scheme, what's the default? You don't say what it is.
The default is alphabetical order. So you may be trading all the same AAAA stocks. We're talking about AMI Broker now. Steve's a member of our AMI Broker group. The second thing that it will do is I think it will take positions that have a higher, that use more capital or that have a higher price. I can't remember exactly. I've got it. Remind me, Steve, I've got it written down somewhere and I can send that to you. Okay, next slide, please. So keep calm, guys. It's a conclusion. Okay. Next slide, please. So best results in big letters on a platter. CCI, MFI, RSI, Stochastics roll-up, MACD. Those are good things to look at if you're interested in building a system that is quantified and based on technical analysis. I use a lot of technical analysis in my system development. Next slide, please. Okay, so moving forward, guys, if you want to move forward. And I apologize, there's a lot of, I tried to keep this to like one slide for conclusions, but it's really not that simple because there's a lot of moving parts. So now let's talk about moving forward. So if this is something that, let's say I've got you interested in and you're on board with, perhaps you want to move forward. These are some of the considerations. So all indicators tested using simple rules exhibited positive expectancy to varying degrees and are possible starting points into further study and development for systems. No commissions were used, okay? So be mindful of tests that had large total trade numbers and low expectancy percentage, okay? That's a red flag. These will be most negatively impacted by commissions, slippage, and market action. So commissions and slippage should be added in a major consideration moving forward. Some tests might actually yield negative returns after those things are added. So that's something to be aware of. Trust but verify. Go ahead, Sue. Okay, so here's some things to be aware of now if you're going to move forward. So some test conditions may actually be near impossible to duplicate in real time. So I gave you the example earlier of EMA crossovers. So if you're buying an EMA crossover on the close, it's near impossible to do in real time because you don't know that the cross has taken place until the bar is actually closed, okay? Typically, MA crossovers are and they should be executed next bar unopened. So the code in the second test runs were adjusted for that, right, to be more realistic. And note the results dropped quite a bit. That's why the EMA crossovers got bumped right off the list, okay? So be mindful of what we call future leak, okay? So the example is buying on the open of the bar where the crossover took place, but before the actual bar closed, which would have signaled the crossover. So let's look at an example of what that looks like. So here's a crossover. Here's an MA crossover. So a lot of people, and JB and I actually had a funny incidence of this where we were helping somebody that basically they back tested their system manually. So a lot of times what they would do is they would say, well, here, I bought here on the open. Well, how did you know that was a crossover until it closed, right? You don't, well, it's obvious. Well, okay, it's obvious when the chart has closed, but if you're looking at that in real time, it's not so obvious, right? Look, if you're trading below the moving averages, you don't know that that's the signal bar. So a lot of times what happens is they'll say, well, I bought on the open here instead of buying on the open or the close on this bar. So a lot of times when we do moving average crossover studies, what we say is if this bar closes, this moving average will cross over on the close, buy the next bar on the open or the next bar on the close. So if you look at this, if you were to buy on the open, you're a friggin' genius, right? Look at all the upside. But if you actually bought on the close here or even on the open, right? It's a different story. So that's future leak. So most important of all, I probably should have put keep calm, it's the conclusion a little bit later. So know what to expect from your trade rules or your system. That's super important. Try to better quantify and understand your potential results and your potential drawdowns and other key metrics. Okay, that's important. Make more quantified decisions and be more systematic. That's the challenge for us technical analysts. Sue? Okay, if you have any questions. So this is just going to be a little soft plug, and I appreciate you all staying with me to the end. I'm starting a new website, which it's sort of operational now. It's systematic.investors.com. If you need more help being more systematic in your own investments, or if you're interested in semi or fully automating your trading, that's something that we're doing. We're going to be launching in the new year, but you could sign up for a free newsletter to stay in what I call the systematic loop. So, as we announce new developments, as things happen, you can sign up. It's free. And there's actually going to be a free account there too, where we, give you some good free stuff. Things like this, things like other studies we're working on. But if you want to stay in the systematic loop, please sign up. We'd be happy to have you on our newsletter. So are there any questions? Sorry, Sue.
I think we covered everything.
Thank you. No questions online?
That was great.
Great. Thank you, everyone. So if there's no other questions, I think we could probably stop the recording there.
Okay.
So thank you, everyone. I hope that was helpful. And we went 10 minutes over, but we started, 25 minutes late.
Sid
So
says, great presentation, Dave. Thanks
Thank
for
you,
all
Sid.
your work efforts. Wayne says, awesome work, Dave.
thank you very much. Great. So the presentation will be available to anyone that wants a copy. I think, Sue, that just gets sent out for anyone who's registered. Is that correct?
Yeah.
And the recording will be available on the CSTA website. So if you have any questions, send me an email, dave@systematic-investors.com. Be happy to answer any questions. If this is something you're interested in learning how to do, by the way, and you're a do-it-yourselfer like I am and like Steve is and like JB is and like Omar is there anyone else in the AMI broker group? Phil was at the last meeting trying to get Phil on board. So AMI broker is a technical platform for charting, and it's what allows us to, it has a